Financial institution fraud continues to evolve as criminals exploit increasingly sophisticated financial products, payment systems, and global banking networks. Among the specialized fraud risks facing banks and other financial institutions are letter of credit fraud, inside and outside fraud schemes, regulatory reporting violations, and failures in operational risk management. Because financial institutions serve as intermediaries in large volumes of transactions, they are particularly vulnerable to schemes involving deception, falsified documentation, collusion, and abuse of trust. Effective fraud management requires a combination of preventive controls, regulatory compliance, employee vigilance, and risk-based monitoring systems. Understanding these advanced fraud risks is essential for fraud examiners, compliance professionals, auditors, and financial institution management. Letter of credit fraud involves the misuse or manipulation of letters of credit, which are financial instruments commonly used to facilitate domestic and international trade. In a legitimate transaction, a bank guarantees payment to a seller when specified contractual conditions are met. Fraud occurs when parties present falsified shipping documents, counterfeit invoices, forged inspection certificates, or non-existent goods to trigger payment. Because banks often rely primarily on documentation rather than physical inspection of merchandise, fraudsters can exploit weaknesses in document verification procedures. Such schemes may involve exporters, importers, brokers, shipping agents, or bank employees acting individually or in collusion. Thorough document examination and due diligence are critical safeguards. Inside and outside fraud schemes represent two major categories of financial institution fraud. Inside fraud involves employees, officers, or other insiders who abuse their authorized access to steal funds, manipulate records, approve unauthorized transactions, or assist external fraudsters. Outside fraud is committed by individuals who do not work for the institution, and typically includes identity theft, counterfeit instruments, account takeover, phishing attacks, and loan fraud. In many cases, sophisticated fraud schemes combine both elements through collusion between insiders and outsiders. Because insiders possess detailed knowledge of controls and procedures, their involvement significantly increases fraud risk. Consequently, institutions must address both external threats and internal vulnerabilities simultaneously. Preventing financial institution fraud requires a comprehensive system of internal controls, governance structures, and risk management practices. Effective prevention begins with strong ethical leadership and a culture of compliance. Segregation of duties, dual authorization requirements, independent reconciliations, employee background checks, mandatory vacations, and continuous transaction monitoring help reduce opportunities for fraud. Financial institutions should also implement robust cybersecurity controls, multi-factor authentication, fraud detection analytics, and employee training programs. Vendor management and customer due diligence procedures provide additional layers of protection. Because fraud risks constantly evolve, prevention programs must be regularly reviewed and updated to address emerging threats, technological changes, and evolving criminal techniques. Suspicious transaction reports, STRs, play a critical role in detecting and combating financial crime. Financial institutions are required in many jurisdictions to monitor customer activity and report transactions that appear unusual, suspicious, or indicative of criminal conduct. These reports support anti-money laundering efforts and assist law enforcement agencies in identifying fraud, corruption, terrorist financing, and other financial crimes. Common indicators triggering suspicion include unusual transaction volumes, inconsistent customer behavior, complex fund movements, unexplained international transfers, and activity lacking apparent economic purpose. Effective STR programs require employee awareness, automated monitoring systems, clear escalation procedures, and a strong compliance culture that encourages timely and accurate reporting. The Basel Committee on Banking Supervision serves as a global standard-setting body that promotes the safety and soundness of the international banking system. Established by central bank governors and banking supervisors, the committee develops principles and frameworks addressing capital adequacy, operational risk, governance, risk management, and supervisory practices. Although its standards are not legally binding, they strongly influence banking regulations worldwide. fraud risk management forms an important component of operational risk oversight under Basel guidance. Institutions are encouraged to identify, assess, monitor, and control risks arising from internal processes, personnel, systems, and external events. Effective implementation strengthens resilience against fraud-related losses and operational disruptions. Operational risk management is closely linked to fraud prevention because many fraud schemes exploit weaknesses in processes, technology, or oversight. Financial institutions must establish systems for identifying vulnerabilities, evaluating control effectiveness, and responding to emerging threats. Risk assessments should consider employee misconduct, cybercrime, third-party risks, transaction processing failures, and regulatory compliance issues. Continuous monitoring enables institutions to detect unusual patterns and intervene before significant losses occur. Independent audit functions provide additional assurance by evaluating the adequacy of controls and identifying areas requiring improvement. A proactive operational risk framework reduces fraud exposure while supporting regulatory compliance and organizational stability. An effective financial institution fraud program integrates prevention, detection, investigation, reporting, and governance into a unified risk management approach. Fraud examiners contribute by analyzing suspicious activities, investigating allegations, assessing control weaknesses, and recommending corrective actions. Management, compliance personnel, auditors, and technology specialists must collaborate to ensure controls remain effective in a rapidly changing environment. Regulatory requirements, such as suspicious transaction reporting and adherence to international standards, reinforce accountability and transparency.